the thing that I would do is like, I wouldn't go massively uncomfortable. I would just creep a little bit outside my comfort zone, a little bit out, and then I get comfortable with that. And then I'd push a little more and push a little more and push a little more. And then after like a couple of years, I'd look back and be like, wow, I've really changed. But if I was to try to make too big of a leap, it could just be too shocking.
All right, guys, welcome to another episode of The Report. Today, we got some sunshine outside, and we're about to go into Labor Day weekend. I don't know how the summer is almost officially over, but I'm super excited because I got someone on the podcast today, someone who I've actually known for quite some time, but first time meeting in person, a big name multifamily broker. He's a real estate investor himself. He's doing big deals up in Orange County. I got my man, Dan Blackwell. Dan, welcome to the show.
Hey, thanks for having me, Rich. Appreciate you, man.
Yeah, dude, appreciate you coming down, man. And yeah, we were talking before we started recording. My brother-in-law actually brokers small multifamily stuff up in Orange County and has been doing it for like 30, 40 years up there. And you guys actually know each other. Small world.
We know each other. He's a great guy. We've done deals and look forward to doing more with him.
Yeah, shout out to Greg, my brother-in-law. He's been married to my sister for like, I want to say 35 years, something crazy like that. So yeah, good dude. But yeah, man, I'm curious, how did you get into the multifamily brokerage space?
Multifamily brokerage. So I got in multifamily brokerage the day Lehman crashed. September 15, 2008 was my start date in California. I lived in North Carolina. Before that, grew up, went to school there, went to college there, never thought I'd leave. And I was selling land for a developer, home developer in coastal North Carolina. And the market was crashing in 06-07. And that developer I worked for went belly up. And I started talking to some other folks, and I was reading Rich Dad Poor Dad, and I was buying rental houses because the land wasn't producing any income. So you can't ride out a storm. You got to bleed a lot of cash through those downturns. So you got to have heavy money. Well, that was my wake-up call to get into income property. And then I was owning some rental homes, and then there's really no scale to that. I mean, there's people that are doing it, but for me, there wasn't a lot of scale to it. There wasn't scale to it within my small town. And I said I wanted to get into multifamily. That was my product type I wanted to pick. And I basically read another book by Jorge Perez, and he said, you got to have three things. You got to have the right product type for you. You got to have the right market, and you got to have the right team. So I spent like 6 months researching, found out SoCal is where I want to be.
It's interesting that you actually like analyze the markets because, you know, as a real estate investor, we will analyze markets and you want to be selective with your market selection. However, I have not heard of like a broker or an agent, for that matter, analyzing the markets and being like, hey, this is the market that I want to go attack. What attracted you to the market selection?
I mean, I studied finance in college, so I'm a data guy. Not too much data, but enough to, be dangerous. And basically what I was looking at was when I worked for a developer, it was great when it was great. When it was not, I was dependent on him. So if he wasn't buying any more land, then I didn't have anything to sell. So I wanted to work into the open market, and I wanted to work with private clients. Second to New York, this is probably one of the highest concentration of small multifamily property market in the country, SoCal. Great place to live. And once I knew the macro level to be in SoCal, I got hired, and we can go into this a little later, how I got hired and got my start. But within Orange County, I basically said, I went back to the numbers and said, I don't know any markets in Orange County. What market trades the most? That's the most logical. If you're a broker, you want to work where the action is. Yeah, you want to sell properties up and down the coast, but Anaheim in particular had the highest transaction velocity rate year over year. So I said, that's the market I want to work. But little did I know, every other apartment broker comes up to the same conclusion. So there was literally internal competition throughout the wazoo.
Yeah. And so how did you choose North Orange County and specifically multifamily? Because you got all these, asset classes out there, and why not residential? Like a lot of folks start in the residential side. Why did you go straight to commercial multifamily?
I mean, it kind of goes back to like Warren Buffett. I read some of his books, and he's like into boring things that make a lot of money that are scalable. And, he talks about apartment houses. That's what he calls them, and he's like, basically, I looked at some of the things from him, the apartments that, some of these buildings we're selling are built in the 60s and 70s. Well, the tenants that were living in those buildings in the 60s and 70s had jobs that worked for companies. Those companies could be long gone, but the apartment that they're living in is still functional and being rented today. So there's longevity to it, unless somebody's going to change the way we live, right? It's an essential. We need roofs.
I would say multifamily is evergreen. There's never going to be a replacement for two things: a place for people to sleep and a place for people to store their belongings. And I think if you look at all the asset classes out there within commercial real estate, you got office, retail, you got hotels, industrial, and you got apartments. You got a bunch of other ones as well. But out of all those, multifamily is going to be the best lending terms. You can even get non-recourse debt because of that. And then this asset class is going to be around forever. So I love that. But so anyways, tell me how you got hired. You said there was an interesting story.
Oh yeah, it was a good one because, I really didn't know the market. I didn't know. I was in North Carolina. I had some success selling land. I had my license, but if you're transitioning over to California, there's no reciprocity where you'd have to start over and get your license all over again. So I'm like, don't know the market, don't have my license, never been here before. It's kind of a low probability hire, right? Even though I was making a couple hundred, I had 1 year where I made a few $100,000 in college selling land. I caught the lift in '06 and worked my tail off. But I interviewed with a couple companies. I interviewed in San Diego, actually.
Really? Which brokerages?
I interviewed with Marcus Millichap,
Okay.
CBRE, and I think Colliers. But Marcus was really, from my data research, had the best training and that I could find. And I still feel, that they're one of the best in training to this day.
Why is it? I feel like I know a lot of brokers in different markets and different asset classes, but I feel like M&M does have the highest concentration of like new people in the game. Why is that?
I mean, well, look, they have a great platform. They have a great training platform. They'll hire a lot of people. It is kind of a numbers game because the probability is so low of somebody sticking. If you look at my training team that we went through training, and then 5 years later, there was only like out of 100 people, there was maybe like a few people that actually was left after 5 years. So it's like you need to hire a lot of people, and Marcus was okay with that program. But back then, that was like I could feel that they were willing to maybe hire me, number one, give me a shot, and then number two, have the training. And since then, I think a lot of other companies, CB has really stepped up their training, and they have a great platform now. But back then, it wasn't as strong as it is now. So Marcus, that being said, I was really set on Marcus and Millichap getting a job there. And I interviewed. I flew all the way out from North Carolina. I didn't even know how to tie a tie. I slid it out and slid it back on. I put on a jacket, cut my hair. And they're like, hey, you know what? Within a 2-minute interview, 2 minutes into the interview, they're like, we're not going to hire you. We're interviewing a lot of people, and I can just tell you, I'm just going to cut to it. You talk too slow, and, I don't think you're going to make it. And I didn't feel upset about that. Like, I was just like, I was a little bummed, like, give me a shot. I had some success, whatever. But the guy was making a judgment call, and he was doing his best thing, and he was going through a number of hires. But what I did do was not take that as a no. I went back, looked up online, where's the next location of Marcus Millichap? They had an office in Irvine, just outside of Newport Beach. I go, okay. I called. The regional manager hired me from there. He says, hey, I'll meet with you. And I went up and met with him, and he said, I'll make room for you. And I barely got in. I felt like I barely got in. But
yeah. And you told him that the door didn't open for you down here.
I was up front, straight up.
Yeah, I love that.
And luckily
But he probably liked that. He's like, the door closed for you, and then now you're like, okay, well, let me see if I can make it work here.
Yeah, I called him like 3 or 4 times. He called me back. I had to cancel my flight. He saw me doing some things that, I was making an effort. And I met him for like 4 hours. It was just a click. And I knew leaving that meeting, it's back to those 3 things: product type, market, right team. I knew that guy was going to be a mentor. And I said, if I don't go for this, I'm always going to wonder what it was like. So I went for it. But yeah, they hired me and they trained the heck out of me, and they were really patient with me and leveled me up.
Now, I think a lot of people realize or don't realize in this commercial real estate brokerage game, it's like you're a brand new agent. I mean, a lot of it is like pounding doors, phone calls until you really establish your database. You could go 12 months easily without making a paycheck. And so what was that like for you being new in the game?
When I came out here in '08, we all knew, the whole market knew that the market sucked. But once Lehman crashed, my start date, I remember seeing that guy who hired me, and he's like, oh crap, I hired this guy. It's kind of like, oh, he's here starting, like, ooh, oh, you'd already moved out here and everything. We knew it was going to be, that's when the capital markets really froze. It's so hard. It'll break you. If you're really pushing yourself, it'll break you. And I think you have to let yourself get broken, and you have to rebuild yourself. and you have to constantly refine yourself. And I think for me, I went back into that hiring manager, the guy that gave me the job, and I went to him and like a couple months into it, and I go, Joe, I'm not giving my all here. He goes, what are you talking about? And I'm like, I'm giving like 80%. He's like, what are you talking about? I'm like, if I give it 100% and I can't make it here, I'm going to have to take the expectation of what I think of myself and lower it. And I just, dude, I can't. He's just like, what are you even talking about, man? You got to go all in, all in, all in. You got to burn the boats kind of thing, right? And it was my time, like, to say, I'm really going for it. I'm being vulnerable here. I'm doing it. And I mean, I ran out of cash. I went from making a couple $100,000 that one year in 06 to like 07, I didn't make much. I think I made less than 40,000. 08, I made like 10 grand. Then 09, I made nothing. I got on the phones here in January of 09. I didn't close a deal, I want to say, until like, actually it was like November of 09. But in between that, my car got repoed out of the parking lot of Marcus Millichap, and I never got it back.
You stopped making the payments or what?
There was guys and gals in the cubes at that time doing workouts. Short selling was a big thing. And I had some land in North Carolina that I bought, and the value went down by 90%. It went from being buildable, long story short, to not being buildable. And there's no value in that. It had water rights to the Intercoastal Waterway. But I got smashed, and I had a couple rental houses. They were vacant, and an older gentleman that's one of my mentors was like, Dan, this is going to be hard, but you're not going to be able to focus on how tough it is here, not making any money. And then you got all that shit, sorry, but like in your life, you're going to have to probably let some of that go or get it sold. And I got it sold, and, you know, some of them I lost it to the bank. And that's just part of my journey. And I saw, back to your point, I saw all these people doing workouts. So I'm like, oh, I'll just call the bank. I've always paid all my bills. I've always been 20% down, 25% down. I didn't do any of they had some really creative stuff back then, but these loans were coming due on land in 1 year. They'd balloon on you. So anyways, I basically called the bank and said, hey, I'm going to miss some payments. Can you work out a loan? They like repoed my car in 2 months or whatever it was. And other people got workouts done. And
the landlender repossessed your car?
The loan on my car, I only owe like $7,000 on a Chevy Tahoe.
Yeah.
But I called for
you stopped making those payments too.
I just did, dude,
you
know, and they pulled it. And I mean, it was scary times, and I was just trying to survive. And I had enough confidence. Here's a big thing. Like, I had enough confidence in successful selling in North Carolina that gave me the confidence to just stick through it. And that my decision to get into commercial real estate and picking the right market, the right location, the right team, when I questioned myself, you're always going to be like, was this the right decision? At times, right? But given that I questioned myself, I did my due diligence. I was like, no, I'm staying this path. I'm not deviating. I'm not going to go jump over here and be that LinkedIn dude with 10 different resumes, jobs. I'm going to stick this out. And then eventually, things started to get traction. But yeah, I didn't have a car. The guys in the bullpen were driving me to work. It took me 6 months to close from repo to, I was crying.
What's the bullpen?
The bullpen's an open cubes where all the juniors work. And if you don't, you have to make a certain amount of income before you get an office. So we would all be in the bullpen and we'd help each other out.
So it's like what, the hallway or the closet or what?
No, it's an open, there's like 50, 60 cubes, and all the agents that, are newer, maybe they're just an associate or they're a junior.
So it's like the bullpen, you're just getting warmed up.
You're out there cold calling. And actually I made enough to get an office 1 year. Finally, you kind of want to get out of the bullpen because there's a lot of internal competition. And I remember my hiring manager calls me, he goes, I need to see you. And I'm like, what's up? And he's like, I know you just earned an office, but I don't want you to take it. And I'm like, why? And he's like, I need your energy in the bullpen. Other people activity breeds activity, because if multiple people are on the phones, then other people are going to want to pick up the phone. But if you don't, the phone gets heavy. And I said, okay, fine. I won't take an office. I've been waiting for this day for like 4 years, but all right, I won't take an office. I really respect this guy. So my best friend, who I've been in the bullpen with, he was eligible for an office. I didn't take it. He took it. He got out of there. I'm like, dude. So I had to wait a whole nother year before I could get an office. But yeah, it was gut wrenching not having a car. It was crazy. Cold calling people, trying to drum up business, not going home for, Thanksgiving. I didn't go home for a couple years. I had so much to try to prove. I was so far away from family. I grew up in North Carolina, being in San Diego or Orange County. It's just, you can't go home real quick and just, catch up. I also have a tail between my legs too.
How come? Just from like the management?
I mean, I'm not making any money. I'm completely stressed out. I'm out of my comfort zone. And that whole thing, like, be comfortable with being uncomfortable. I mean, that was like the thing. But the thing that I would do is like, I wouldn't go massively uncomfortable. I would just creep a little bit outside my comfort zone, a little bit out, and then I get comfortable with that. And then I'd push a little more and push a little more and push a little more. And then after like a couple of years, I'd look back and be like, wow, I've really changed. But if I was to try to make too big of a leap, it could just be too shocking.
Yeah.
But I was always doing that. I just didn't want to go back home and be like, hey, I'm broke and I don't have a car and feel like a.
So how did you, and at one point you were living in your car, right?
Yeah.
And how did you like process these first 3-4 years with making what you were making? Car gets repossessed. You're living in your car before that. At one point, did you realize, hey, this might not be for me? Because I'm sure that crossed your mind, right?
I kind of did. My buddy that took the office, Nate, it skipped me out, but he was the one who drove. I think the people around you, there's always a question like, what deals kept you in the business? What income pop did you get to stay in the business? But also what people around you kept you in the business. And I mean, there was a defining moment when I was like, had a heart to heart with him. And I'm like, dude, I don't know if this is for me. It's so wildly competitive. It's ridiculous. But I just didn't have another option. I didn't want to be a W-2. There's nothing wrong with that. But I never got used to that. My first mentor told me, hey, look, it's harder to transition when you've got used to that paycheck. And then you need to get off, then you're trying to get off of it. Just don't ever get used to it. So like, I just didn't know what else to do. And I knew that was where the big money was in brokerage. And I knew, okay, so back to your first point, like how'd you get multi? I knew eventually I wanted to get on the other end of the telephone. I wanted to get to the principal side of the business. And if you don't have any money and you really don't know what you're doing, you could specialize in what you want to buy, right? I mean, that makes most sense. Then you can build an edge and then good deals when you see them. So that's also why I picked multi. I didn't really get excited about office or industrial or retail or nothing wrong with that. There's tons of people that are wildly successful in anything, but just didn't do it for me.
Yeah, that's crazy. Tell me about the car situation. You mentioned that you live in your car. That was what, in the first few years?
Yeah, I was kind of like living. I rented an apartment in Newport online. UDR had a big building, but within 3 months, I sublet the apartment, and I kind of was like living in my car. It was weird. It was highly uncomfortable. I remember trash bags of clothes. I remember I got like this little roller, coat hanger thing, and like I kind of modified it to put it in the back of the Tahoe. And somebody at Mark's Milchat gave me a blow-up mattress, a little single. And they were like, dude, you can use this. And I slept on some couches for a while. I wasn't like in my car for a year, but I probably had 2 full weeks of straight car. It was cold one night. That's what I remember when it was like really cold. And I woke up and I looked down and I'm like in a sleeping bag and I'm in the back of the Tahoe. There's so many good things that happen. My boss, Joe, who hired me, was like, this is character building. And I would call my dad. I built a great relationship with my dad. We didn't have the best relationship. When we saw me struggling, he would walk me through it, talk me through it, and we have a great relationship. He's like, son, he went to Vietnam. He went through me sleeping in a car in, Irvine, California, one of the safest cities in the world. Like, ain't nobody shooting at me, So you have to put it in perspective. But it was tough, man. It was tough. And the guy that hired me actually said, hey, look, the guys in the bullpen told me you're sleeping in your car. Because there was a gym down below and I was going down the escalator. People were coming to work at 8 a.m., 7:30 or whatever, some early birds. And I was going down at like 7:30 with a hoodie on and goes like, oh shit. And one of the guys told the manager and said, hey, Dan's living in his car. I saw it like open up and all this stuff. So he could see all my clothes and everything. So the manager was like, I want you to come move in with me. And he had a family. He was married. He lived 30 minutes away, and he was the one who hired me. Probably felt a little guilty that I was struggling so bad.
Oh, he took you in.
He's the one who took me in. He's like, you can come move in with me. Italian guy, great heart. And I said, all right. But I would come home to his house at like 10:30. I'd work till like 10:30 at night. They're already in bed. They'd have food in the microwave, little note. His wife would write a little note. I made you mashed potatoes, turkey, and gravy. Just heat it up for 1 minute. Put a towel, napkin. Don't blow up the microwave. And then I'd eat it. I'd wash the dish. I'd put it away, put all the silverware away, go to bed, wake up at 5, get out of there. I was a ghost. I did that for 3 months. Then real quick, some guys in the bullpen were like, hey, we have a beach house and we built this extra room. It's a 4-bedroom, 2-bath. We build another room and somebody's living there. Do you want to move in that one for $500 a month? And I'm like, okay. So I moved in there. I lived in a fake room for the next couple, dude, it was a long time. Like these cycles, like, that whole, like, let's survive to 25 sounded like a long time 2 years ago.
Yeah.
But look at it. We're 4 months away to 25. Like
Yeah.
these things take a while, but I was struggling for a long time. But I built up, they said, hey, look, I'd go to my managers and I'd be like, what's the next move? And they really helped accelerate me. I started buying back my time, like Dan Martell says in his book.
Love Dan. Big fan of him.
He's great, but I'm sorry I'm rambling. But yeah, they said, look, next goal, get 300 grand in the bank. And I did that, living in that room until I hit that milestone, and then started doing some investments and stuff.
Dude, I love that, man. That's a freaking crazy story. So, then fast forward to now, right? You're freaking, one of the top brokers in Southern California, multifamily, killing the game in North OC. But people see the end product, and that's everything in life, every aspect of business. People see the end product and some say it must be nice, but they don't see all the grind and all the years and all the heartache that you went through, getting the car repossessed and living out of your car, all that sort of stuff. So what's your biggest takeaway looking back now at all that? I mean, it's gotta,
I think there's some defining moments. Like I remember when my car got repoed, like I literally had a nervous breakdown. Like I started crying. It was just, that's a gut punch, man. I actually had a job at Starbucks that's still up there on Bristol.
While you were selling
in Newport.
Multifamily.
Yeah. Damn. And like the guys from work would
come in.
I'd be embarrassed, man. Like, look, no job is beneath me, but when you have to when you build up a lifestyle and then you have to go back down, that's the hit, right? That's the hit. But I mean, I had literally this Rolex is the only thing I kept from 06. And this thing has been in a toilet bowl, scrubbing toilets at Starbucks. And I remember looking down, I got the watch in 06. I held on to it in 09. I'm scrubbing toilets in Starbucks wearing an apron. And the job's got to get done. But I'm like, damn, that's one hell of a picture.
Yeah, it is one hell of a picture. That's crazy.
With the hand and with the Rolex and the But yeah, I mean, it was brutal. But I think one of the defining moments was like when the car got repoed. A lot of stuff you block out just to survive, But I never forget, like, I felt that terrible feeling in your gut, all that emotion, all that pain in your back of your throat. You're crying. I remember walking down, just crying for a little bit. And I got up. Once it went away, once that feeling went away, I was like, I'm going to go start cold calling. Like, I'm going to go back. And that was the defining moment.
Yeah.
Because that makes or breaks you. You know what I'm saying?
Yeah.
Like, I'm literally just had my car repossessed and I'm cold calling, getting rejected. But I just got comfortable with that.
I love that, dude. That's a crazy story. So I want to talk a little bit about what's going on in the market today. So you mentioned that whole saying, survive to 25, right? Now I started hearing that like late 22, early 23. And it is crazy that it is almost 2025 now. And sure enough, the next Fed meeting is in September, and we'll likely see a rate cut here for the first time in about 30 months, right? So it is interesting. Now, I'll say this. You mentioned that cycle was very tough, 2008, 2009. Now, this cycle, at least from what I'm seeing, is not nearly like the same one that we're talking about. And so for me in this cycle, I mean, I'm looking around and I'm connected in the space. And yeah, it's like values aren't skyrocketing and people aren't, doing these cash out refinances like they are in a good cycle. Credit card debt, delinquencies up, people have less liquidity. Unemployment's starting to tick up, right? And the high interest rates are finally working their way through the system, and thus we're going to see some cuts here soon, hopefully. But that said, I feel like it's not like all these repossessions and properties going back to the bank and a lot of this stuff that people were alluding to.
Yeah, I know. You're absolutely right. It's different. I mean, but on a transactional level, it's tough out there because a lot of youngsters that are younger in their career, if they don't have relationships, like the deals aren't making.
Even in this cycle right now, the young folks it's tough.
It's tough. It's tough. It's like a lot of teams expanded and everybody got real, probably too big. And then, ourselves included. And it's just like, it's got a right size, right? We're not seeing distress. When 08 hit, all the distress was single family homes, 2 to 4 units within this market. The 5 unit up, everybody was gearing up for, really depressed prices, and they were going back to comps in the mid 90s going like, oh shit, things could get really interesting. Prices came down, but we were one of the last markets to cycle down and one of the first markets to cycle up. There wasn't really a whole lot of distress because assets kept cash flowing. from our vantage point, there's not a lot of bridge debt in this market. It was a lot of conventional debt put on. So there is some bridge debt that has gone bad here, but very few, that are going back or having to get reworked out or getting sold. So there's really not a lot of pain there. So that's like very little amounts of like transaction volume. So it's super hard. Luckily, I'm further down the road. I've got deeper, I built some relationships and got some transactions to keep things going. We got a great team. That's big.
What have you guys seen in terms of like values over the last 30 months with the high rate environment in the space that you're playing in?
So values, I mean, I'll just ballpark. I didn't put any numbers together before this, but some of the coastal markets are down less than 10%. Some of your interior markets are probably 10 to 12. Santa Ana's gotten hit within Orange County harder, maybe 15, maybe 20, somewhere in there. But, rates are reeling back in. One of the challenges with our market is it's not a lack of buyers. It's a lack of sellers that are motivated to transact in today's market. That's where there's a lack of. So it's good for the overall market. But what the challenge is these cap rates.
And that's primarily because these sellers know they're not going to get top dollar right now. So they might as well, and they don't need to sell.
They're not in any pain.
They're not what?
They're not in any pain.
Yeah.
The lender, it's functional. Like there's not a lot of distress. Like everything's fundamentally sound. We have a lot of headwinds. We have insurance issues. We have deck inspections that are going to become in law, SB 721. We have all sorts of like pressure from regulations from, the whole Prop 33 that's going to be on the ballot here in November that's going to be voted on that we've already defeated twice in 2 other iterations. So there's always headwinds. Like a couple of years ago or 3 or 4 years ago, it was tailwind. Now it's all headwind, or mostly. But the challenge is the cost of debt is today about 5.5, maybe 5.75. Our cap rates are below that. So you're borrowing at it's negative leverage. Unless there's a significant upside story to this and for you to get positive leverage, then the borrowed dollars aren't working for you. They're working against you. So that's one of the things is like it's a negative leveraged environment. So you either pay cash, you work out. Hopefully there's an assumption you could do a seller carry, or you just try to get a minimized prepay so you can refinance maybe in when rates do come in more.
Yeah, I'm curious, like on stabilized debt in Orange County, multifamily wise, like what kind of leverage are you getting? Because before the high rate environment and the rates were 2.75%, 3%, buyers were still putting down close to 50% to meet the DSCR requirement. But now with rates essentially doubling, what kind of leverage can they get?
Well, because prices reeled in a little bit and some rents have grown in that period of time too, a little bit.
If prices goes down 10%, you're saying, but rates have doubled.
Rates have doubled. You're still putting 50, 60% down. Unless you get into some markets that got hit harder.
Mm-hmm.
Like
such as what?
Parts of LA, you're able to put 30% down, 35% down in some deals because the cap rates have shot way up.
Yeah.
And
those are rougher areas.
And there's more regulation. A lot of capital doesn't want to be there. So there's more opportunity. So they're going to lend off the cash flow to your point. But yes, we were selling 3 caps and they're probably 4.5, but some NOI has grown. So it's not all deteriorating value, but you're getting 40% LTV, 50's like pretty good. We haven't seen much higher than that off conventional financing.
Mm-hmm.
It's tough.
Have your more like savvy investors, have they been buying over these last couple of years, or a lot of them on the sidelines?
It's a mix. There hasn't been enough sales for everybody to participate. Certainly, some that have a higher cost of capital have been sidelined, and it just depends. Like if they bought in 2021, 22, if they bought a lot, they're probably just focusing on operations, right, and prepping for when those loans index. But some have taken advantage. We talked about one before we went live here that went down in Garden Grove. But people are still buying. And if your cost of capital is too high, you can't pencil deals. Your pencil's down, But other people are like, look, I'm a single investor. I've got capital. I can make a decision if I like the basis and like the long-term play.
Yeah, I mean, our approach strategy-wise, like through the last 30 months, is really been focusing on value-add projects where we can buy at a discount and we can add tremendous value in good locations. And this is in the hotel space, but I knew like, hey, we're in a high-rate environment, so obviously like the cash flow is not going to really be there. But if we can buy something at a discount right now and we can have a clear path to double the valuation in 18 months' time through our renovation platform and our marketing strategies through growing the NOI. Then it makes sense, right? And so that's kind of been the the stuff that we've been picking up, but like more of that turnkey stuff where I'm like, hey, like we're just gonna park our money and let inflation do its thing. That stuff we've completely stayed away from.
To that point, we've sold some stabilized assets, and that's a really good point because those actually got hit, significantly, because maybe even more than some of those averages I just mentioned, depending. Because if you're stabilized at a 5.5 cap and your cost of debt was over that, and that you can't even, there's no value add program to really get over the hump, then that's not going to work. Those are not clearing. Those caps have to be parred out with the cost of debt or pretty close.
As a busy real estate investor or entrepreneur, time is money and first impression is everything. Every day to make it easy on myself, I wear Built Basics clothing. Whether you're a girl or guy looking for workout gear, joggers, shirts, button-downs, hats, or shoes, Built's got you covered. Super comfortable, tight in all the right places to make you look fresh and clean all the time. Visit BuiltBasics.com and use promo code SUMMERS20 to receive 20% off of your order. Again, that's BuiltBasics.com. That's BYLT Basics.com. Use promo code SUMMERS20 to receive 20% off of your order. Now back to the show. No, it's interesting to see. And so would you say how much have the cap rates moved? You mentioned they were about 3 and now they're 4, 4.5 in a lot of these markets.
Yeah, I want to say, like, just going off rule of thumb, there's still deals we're selling in the 3s.
Really? It's for good locations
for
and nice
primo
assets.
stuff.
Yeah, I get it.
And there is, 200 basis points of lift on the cap too. So you can buy a 3.5 cap and you can get it to a 5.5, and it's in primo market. You can get big rents, and that's really that you could probably sell that at like a 4.5 cap. So there's a nice pop. But let's just say coastals went from 3 to a 4 cap, call it 100 basis points on average, and then interior markets you're probably like 125 basis points from like 375 4 caps to probably 5-ish right now. Yeah, so they moved, but not anything like we've seen in other markets where it's like way blown out.
I mean, it's crazy to think. Okay, so when I first got into the real estate game, my first 2 of my early deals were in Cincinnati. It's like 11-unit apartment building and like an 8-unit. I just signed on the sale yesterday for the 8-unit, but the 11-unit I listed a couple months back, and we had multiple offers right away. And I took this one buyer group out of New York, and it was a number I never thought I would get. And I was like, damn, rate environment's really not affecting this. And we get into like 30 days in, and they end up canceling the last day of DD. And so, and I'm under contract on my up leg out here in San Diego. And anyway, so like try to find another buyer, discount the pricing a little bit. And I was like, we didn't get a lot of activity after that. And I knew what I could get. And I was like, I don't have to sell this thing. And so I was like, you know what? I was like, let's take it off the market. I was like, I don't need to sell this thing. And I know what I could get in in a good environment. So I'm like, let's just hold off for a more opportune time. And to your point, like a lot of these sellers, they're not in enough pain. I don't need to sell that thing. And so I'm like, let's just hold it. So, but it was interesting to see even some of these other markets, multifamily wise, I'm like, there's still a lot of activity out there.
There's still activity. We're actually right now starting to get calls saying, hey, I'm in an exchange. We didn't hear that for a while. There wasn't trade money in the market with their down leg closed, because when transactions dried up, then our 1031 buyers, they didn't sell their down leg and things just dominoed out. But we're starting to get calls now, not a ton, but we're tracking about 6 or 7 1031 exchange buyers right now that has money to place looking for good real estate. And that's like, these are $5 to $20 million purchase requirements. And there's not enough good assets on the market to even solve for that little amount of exchange money. But we're starting to see the gears turn again. One thing we've been doing is manufacturing exchanges instead of waiting for a buyer to be in an exchange and say, hey,
what does that mean?
Manufacturing an exchange would be, okay, so there's an opportunity in the market. For example, there's less buyers in the market you have to compete with. So maybe you've got a building and you got a bunch of equity in it and you want to trade up into a better area, but you need to sell your building first and you're trying to find your up leg. Well, that would have not worked out a couple of years ago when there was like best and finals on everything. You'd have to go non-contingent immediately. Well, right now we just structured a deal where a seller wanted to sell a building and he's like, look, if I can get close to my price and you got a good buyer, I'll give them a longer escrow to go sell their building. So it's kind of like a contingent sale, but not structured with that as a contingency. And we just did that. We're closing. It's about $17 million in consideration. The buyer is going to level up from a $6 million asset that he owns. He's going into an $11 million asset. He's not adding any more cash. He's increasing his annual after-tax cash flow by $65,000 a month. He's getting a 25-year newer building built in the 80s. He's getting a better street. better cash flow, bigger building, like he checked every box. And he would have never been able to do that had the market not get dislocated because he had no other real competition. And the seller was stoked because they got plans to move their capital and they were willing to work out the time. So that's manufacturing an exchange where you put someone or you create an exchange versus like wait for one leg to, of a buyer. Hey, I need to buy something because that dried up. So I think there's still that opportunity to do that. So we're calling some of our owners that we knew had a lot of equity. And we're like, look, do you want to trade up? This could be a good time. If rates start to drop, we might see some more competition. Let's try to, figure something out now. So
I love that. And even like that story that you just alluded to, like sharing that with other owners that have a ton of equity as an example, hey, we could do this for you as well. Probably bodes well.
It does. And there's not a lot of there's capital. Capital's always moving, right? But, there's a lot of capital that left the state and they went into other markets and they went into multifamily, retail, they went into everything, right? Then there's capital that's wanting to double down here. But it's California has been less popular because of all the regulation, the rent control. But then we're catching money and capital from LA into Orange County that wants to be in Orange County because they're like, dude, I don't want to be in LA anymore. So it's like there's capital flowing. So usually when we get a good asset that comes to the market, it's usually a family that's inherited the property. They might want to go their separate ways and move their pieces. They've gotten older, like the ownership structure is like expanding. The kids are now, we sold one property, 72 units in Anaheim. 72 units in Anaheim, there was 21 beneficiaries. Like it's just time to, so that created a great opportunity for another buyer to trade in. And that's where you really can make a lot of money too.
How big is the ADU play with a lot of these deals that you're transacting in your market?
So we're modeling every property that we take to market. We feasibility study the asset for an ADU.
So you're looking for the clear path to add value and looking at what you would do as the buyer.
ADU is the new value add. So we have to do it. We have to model this up to maximize value for the seller. But where the ADUs are really popular is in coastal markets where it's the same cost to, put an ADU in Newport Beach as it is in Anaheim, and you're going to get a way better pop on your rent, your ROI, and the equity that you're going to create. So there, garage conversions, more new construction in the coastal markets. Yeah.
And so if a seller comes to you and you do like a BOV, broker opinion value.
Yep.
What are you doing exactly? You're coming up a performer as a buyer and figuring out, okay, if I'm a buyer, these are the value add plays right here for the property. This is the highest and best use. And so based off of what this ARV might be, this is probably what a buyer is willing to pay in today's market.
Yeah, we can look at it on an ARV. We also look at it on the in place. What does it make? Adjusting taxes, the property taxes at the new value, right? Because it's not what that owner might have paid $3 million for the property. It's now worth 12.
Insurance also is likely going to go up.
We have to actually we used to use industry standard for insurance. It was like $250 per unit per year. Now we can't do that. We need to get a live quote. We need to look at the panels. We need to really understand what it is. So that's a big one. But we model it. If a buyer paid, what would the cap rate come to? What is the metrics? What's the price per foot, price per unit, where the comps are? How do we feel the market? It's got to be enough. It depends on the asset, the location. It depends on a lot of different things.
Yeah. Do you guys typically do like some sort of range? This is like best case scenario. This is low end, and then it'll likely fall somewhere in between.
Most of the time we do. I mean, we've gone back and forth. We've went ranges, and then sometimes we could really pinpoint it and say it's pretty tight to this number. It's going to trade right around 10.5 to 11. Or sometimes if we just don't know because there might be some fluke buyer that's like got to have it and we'll pay up, we'll provide a range and talk through it. But I think when the market gets volatile and uncertain, you need to kind of widen things out a little bit within a range, because sometimes, and you got to be honest, like sometimes brokers, like sometimes you can be like, it will not sell for more than this, I can tell you. Or sometimes you're like, I don't really know because we don't have a lot of comps. Nothing's really selling. So it just depends.
Yeah, I don't know. It's interesting, man. It was crazy how like nuts the market was back in 2021 when the rates were like all time low. We had just come out of the pandemic, and we had a whole freaking shutdown and stay at home order. And I was like, man, there's no recession. The government just print all this money. Rates are all time low, and so there's a lot of like confidence in the marketplace, right? And everyone's just attacking all these deals. And it was like the wild, wild west out there. But I remember we had a 32 unit building, couple partners and I that we JV'd. This is one of my first deals early on that I bought in Indianapolis, suburb, 1960s product. We owned this thing for 2 years. We freaking had all the problems. They had plumbing issues. The sewer lines were bad. This thing was just literally a pile of bricks, right? But we renovated half the units. And this building next door, which was a larger complex, it was like a 200 and something unit complex, went to market. They had multiple offers. And so I'm talking to a listing broker and they're like, yeah, like we can get you like this number. And I was like, no way. And they're like, yeah. And then they're like, as a matter of fact, stop renovating your units. And we had renovated about 50%. He's like, just stop. He's like, buyers right now will pay more for unrenovated units than they will renovated. And sure enough, he got us the number. And I was like, oh my gosh, the buyers ended up paying like a 3.7 cap on a 1960s multifamily in a suburb of Indianapolis. And that was when I was like, oh my gosh. And that person raised money to buy it. And that was when I realized, man, like multifamily right now is just fucking bonkers.
It's bonkers.
And that's about the time when I pivoted over to the hotel stuff. But it's crazy to think about. And then also another crazy thing is like my progression as a real estate investor. Like I think early on, I was kind of chasing cash flow because I was, working at W-2 and I was like, I want to just quit my job and I wanted some cash flow. And it was great. But my progression as an investor now is like, now I really value going into high growth markets to where I can, one, add a lot of value, but two, I can really, buy in good locations in high growth markets and let inflation do its thing. Because, in reality, the time and effort and risk that it takes to buy a deal, get it deaded up, if you're going to raise money, and then manage construction and renovation, all that. Relatively speaking, from a time and cost perspective, it's about the same amount of energy for a deal in the Midwest, in Oklahoma City, let's say, versus a deal in Scottsdale, Arizona, or Santa Barbara, California, where you're going to see a lot more appreciation. But I know in these areas that are higher growth markets, I'm going to add a lot more appreciation and equity growth, which is going to be a much better return on my efforts. And so now my thinking is like I only want to go into high growth markets and in great locations, assets that I want to hold for a while. And then also it's like you do all the time and efforts to renovate these properties. It's like I don't want to just give them back and sell them. Like I want to refi these things, pull some money out, and I want to hold them long term and let inflation, let time do its thing. So that's kind of my sentiment and how my real estate investing strategy has kind of progressed over the years.
I love that. That makes a lot of sense. I can tell you know what you're doing. You've got some war stories and you've learned along the way and you constantly refine your business plan. The same with me. I mean, one of the great things about being in brokerage, you can talk to a lot of these owners that have built portfolios and you can see how they got started and how they grew their business. And some, love more cash flow and they're purely about the numbers and they're not looking at appreciation. And some are like, I'll buy a bad deal. I mean, I'm simplifying it, but one of our clients is like, I'll buy a bad deal in a great area. Like he's just such a location guy. I mean, he's not necessarily going to do that, but he'd buy a lower cap deal is what he's saying.
Yeah.
And let the market take care of you.
Yeah. He'll pay market value or retail for a nice asset in a great location.
And he's thinking so long-term, he's buying great product and the rents and everything because you can fix the building, you can't fix the area.
Yeah.
Right.
And in 20 years, he'll make out big time.
He built a massive portfolio doing that.
Yeah.
And just holding, refinancing. He started syndicating and then he started buying. But I love hearing those stories. But, yeah, I think I resonate with what you're saying. Buying in a great location, rents are really tied to jobs and wage growth. So you want to be in a good market where people can pay up. And I think now within SoCal, I think where there's a shift for the money that wants to be here, they're really looking for a good product. Not just being some like kind of price war with like a commodity type 1 bedroom, 1 bath motel style building where there's like, you're just literally in a price war. They're looking for townhouse units. They're looking for single story units. They're looking for stuff that doesn't have all the extra headaches, that doesn't move the NOI, right? And they're scrutinizing the assets and they want their capital to be in those buildings.
The townhouse style buildings are nice. Like we have an asset out in North Carolina, the Arbors, and it's all townhome style units. And in that particular market in North Carolina, like the rents just keep going up.
Where is it?
Greensboro, North Carolina.
Oh yeah.
Yeah, we have another one that's like garden style in that area, but the townhome style units, I mean, the rents just keep going up. It's crazy.
Townhouses, I love it because there's nobody living above you. Yeah, you have a shared wall, but that's, I mean, it's like home ownership.
No one below you.
No one below you. You might be able to get washer dryer hookups. I mean, the retention rate and the renewal rate is probably more
attract
sticky.
more families.
You're going to get more families. They might look around, they can't find another townhouse, so they want to stay, and then the renewal, and there's your cash flow. Heads and beds.
Yeah, absolutely.
Good tenants.
So, how much are buyers looking at, like, because, price per door obviously is a good metric, but there's a big difference if these are large 2 and 3 bedroom townhome style units versus 1 bedrooms and efficiency units, right? So there's a big difference there. And then you got to look at the square footage. But your buyers, like, how much do they play a role or factor in terms of, like, the unit mix and the size of these units when they go and buy these assets?
It's everything. In the heyday, you could list a studioed building with tiny units that was a little funky, and it'd probably clear the market pretty quickly. Now it's like everybody scrutinizes, well, I don't want studios in a down market. That usually those get hit harder, right? Because there could be higher turnover and right, and all this stuff, that can be true. 1 bedrooms back in the last cycle, people doubled up, right? People left their 1, and the 2 bedroom, 2 bath was like the Cadillac. You want 2 twos, sometimes 3s. Sometimes they are hard to rent because then you're competing with the shadow market of houses. But that's kind of blown out to where, like, you're not seeing that this time around. The pricing has blown out on houses. So, as you know, so 3 bedrooms, 2 bedrooms, really people are okay with, they'll buy 1s and 2s. They really prefer 2 bedroom, 2 bedroom, 2 bath would be perfect, but that's hard to find. But I think it's the larger 1 bedrooms still rent really well. So it's all about the size of the unit.
Yeah. Most of the product in the markets that you're in. So you're what? Give us an overview. Costa Mesa, Santa Ana, where else?
Our business line it started in Anaheim, then we picked up all of Orange County. That's our core operating area. We're based out of Newport Beach. We're with CBRE. We run the business line for private capital there. But then we're doing deals in LA County. We've got partners in Inland Empire, San Diego. We just picked up a listing in San Diego, so I'm gonna go take a look at it.
That's the one in Oceanside, you said?
Yeah.
How big is that one?
It's a little tiny one. It's a little 5 unit for 2.1 million, but it's in a prime location. And this client's this is going to be his 6th transaction with us this year, and he's rolling up and trading in to more units.
I love that.
But our clients will take us in other areas, and that's one of the great things about brokerage is you can kind of grow with your clients. So if your client's active and they're building up, hey, I want to start buying over here, and they want to work with you, then they'll take you in other markets.
Yeah. So I guess where I was going with that is these markets that you're in, what vintage properties are these? Is there a lot of this product like 1960s, 70s, 80s primarily?
80s, sometimes people still call it new construction, which is, I slip up sometimes and say that too, but that's hard to find. Primarily it's 60s, late 50s, 60s is probably the norm.
That's the norm.
70s, nice. I like 70s a lot. Those are typically big units. They didn't do a lot of subterranean parking. It was on grade, detached, larger units, spacious kind of grounds. 80s is harder to find.
Yeah. And then do you see anything that's like post 2000 or not really?
We've cleared maybe 10, 15 assets that is like,
yeah, but it's very rare.
Yeah, no, because we're typically, our average deal size is like 5 to 10 million. So a lot of the bigger buildings that were built 200-300 units, those are a lot of newer
stuff. Yeah.
But they're hard to find. They're really hard to find in our size. So, I mean, we'll deal with stuff in the 40s, but now people are scrutinizing the age, rightfully so, because of insurance, right? So they're like, I don't want to buy that 48 construction building that's all single story. I love the product single story, but I don't want to deal with all those problems that come with, a 40s vintage asset. It's a deeper reno versus like just maybe cosmetic.
What's your issue with subterranean parking?
It's not preferred, but sometimes like that's
why is that?
If it's 80s and up, I think you're fine, right? But sometimes you get subterranean that's not 80s, and that can be a retrofit issue. Sometimes it's drainage, right? Sometimes those rent fine in certain markets where that's just prevalent, but some where it depends on if you're in a market where it's all on grade parking and it's kind of like a little neighborhood setting, and then you got one subterranean parking building. Like sometimes tenants don't want that because that's not conducive to the market. It can just be more maintenance.
I know here in San Diego, Andrew Greer, who's a good friend of mine, he's been on the podcast a couple of times, but he's big into redeveloping, properties here. Maybe he'll take a single family on a large lot here, and that lot might be zoned for up to 18 units, let's say. He'll do a tear down and then build the 18 units. And so he's doing a lot of that kind of stuff. And that's very popular right now in San Diego. Are you guys seeing that stuff up in Orange County?
Yeah, it's there. It's not as common. I would love to find a property where you can build 18 units. We sold a fourplex similar in Fullerton in COVID, and the buyer is entitling the property, and then he's selling it to a developer, and they're going to build 26 units on it.
Yeah,
So
that's one of the exit strategies for sure.
there's value. There's tremendous amounts of value, but those are harder to come by for sure. Usually there's already a max level of units. It's not as low density, and the lot's not as big enough, and you can't build as many units as there already is there. So you're kind of stuck with what you got.
Yeah, absolutely. So you're an investor yourself. You said you're on a journey to 100 units.
Yeah.
And you currently have about 30 doors, you said?
30 doors.
Yeah. What's the primary way that you're finding deal flow? Is it when you spot a good deal in the marketplace, you're like, hey, I'm going to buy this?
Yeah. But, the big thing is there's brokers that buy ahead of their clients and some don't. I just don't want to interfere with our business line. So I started buying, and plus it takes so much cash. Like we talked about 50, 60% down. I mean, like, oh my gosh. So I started buying triplexes, and I wanted them super close to the house to where I want to see it, touch it, feel it. And I think that'll make me a better broker. So I wasn't interfering with my clients. I'm getting better resi leverage with residential financing. I got up to, I think it was 70% LTV at the time.
That's not bad because they don't need the DSCR to meet.
They don't need that, right? So they'll lend off your debt to income, right? So I bought a triplex. The clients are like, hey, buy as many as you want. Like, I'm not interfering with buying one of our listings.
That makes sense.
I don't want to damage what we've spent so hard to build, and still putting clients 100% first. But they came on the MLS.
Yeah.
Those came on the MLS.
And some of these triplexes might have ADU potential, right? Where you could turn it into like a fiveplex or something?
There are, I know. I could do that on this one, but these are a little funky where I'd have to do it over the garage and the cost's too high. But yes, I should have bought more where there was, at a corner lot or a big backyard or something. But yeah, I started before I started making some money. I started putting money into other people's deals. So I got all my time back, but I got some investment exposure, and I was investing with some clients that I really, you kind of bet on the jockey, kind of thing. And I knew that the deal was good, but I knew that the person that I'm investing is trustworthy and is going to work hard and do a good job, and they're going places. So I started doing that. And then that was probably 4 or 5 years of doing that while I just continued to refine my broker's business. And then I'm like, said, I need some direct ownership. So I started buying triplexes in 2018. I bought a building every year since then. So,
dude, I love that, man. So tell me how you're offsetting a lot of your taxes through these cost seg studies.
So started making some good money, helping owners buy and sell apartments, tucked it away, kept my lifestyle low, getting hammered with taxes. And
real quick, because I think it's important, because a lot of like agents I know in the real estate space, they don't own real estate. And I think a lot of them I don't know if it's the brokers aren't educating them enough or what it is, but a lot of them don't even realize that they can offset the taxes of their commissions if they were to just own some real estate and get these cost seg studies done.
It's one of the biggest loopholes. So what I was doing was I was getting smashed on paying taxes, and I didn't have any write-off. And I called my CPA. And what I did, one of the things, I got a CPA. I moved over to a CPA that owned a lot of real estate.
So smart.
And I'm like, what do I need to do? And he's like, well, you can accelerate the depreciation on these properties and take it in year one. At the time, we were getting 100% bonus depreciation. So I'm like, okay, great. That's better than me doing some LP deals. Even though you could do that on LP deals, I was like, I want to actually own the asset. I want to buy these great locations that I don't want to sell. And I'll get into that later because there's some risk to doing the cost seg stuff. So basically what I was doing was making a bunch of money in real estate as much as I could. I'd buy a building. I'd go to my CPA and say, hey, look, I'm going to make X around this year. I think, around this time, around September, I'll call the CPA and say, I think I'm going to make them around X this year. How much real estate do I need to buy to wipe out my federal? And he'll be like, you need to buy $3 million worth of real estate. You need to buy 4. I'm like, I don't know. I don't have money for that, but whatever. I'd be like, well, I can buy this $2 million triplex. So he's like, we can do cost seg studies. He gets the whole business because he owns real estate and he's doing cost seg himself. And he's like, look, I'm trying to remember the numbers, but roughly, I remember the first triplex I bought, I want to say it was like $1.5 million. I cost segged it. I put 30% down. I probably got like a $300,000 write-off, and I put whatever the math is around. It was almost like dollar for dollar. It was close, not quite a dollar for dollar.
Yeah, it's about right, because you said 30% down. I would say on average, the deals that we have, we get cost seg studies done. This year's gonna be less because 60%, but especially before when it's about 100% bonus, about 30% of the purchase price or the cost basis would be depreciation in year one.
So then he's like, you can take that and offset as a write-off to your federal income. So that would drop it down substantially. And I said, great. So I just started rinsing and repeating and doing that as much as I could. So every year I'd buy a building towards the end of the year. I got my deals off the MLS because there used to be, I'm not seeing it anymore, but there used to be somebody just list a building and maybe misprice it or whatever. And, I just want a good piece of real estate that's not going to suck up a lot of my time, let the market, take care of me over the long term. And luckily I got 4 buildings on one street.
Damn.
It was wild.
4 separate acquisitions, or this is one
4 separate acquisitions.
How'd you do that?
It was the rarest thing. So one came up on the MLS. One of my clients was like, Dan, you should buy this. And I'm like, oh shit, maybe I should. So I ended up buying it. He was really cool. He let me buy it. I sent it to him first. And he's like, no, you should buy this. This is like down the street from your house. So I bought it. That owner's brother owned the building next door. And that broker said, hey, if you buy this one, I'll call you when, the brother's ready to sell. So she called me the next year and I bought the brother's building. And I kept saving up. I stopped doing the LP deals so I could then have cash for the down payments on my own deals. And I liked being in control of the real estate. I liked doing the renos on my own. I liked, even if I had to overspend, like you learn on your own dime than somebody else's dime. I was cool with that. That kind of resonated with me. I was doing the thing. I think if you own, I don't mean this as a diss to anybody, but back to one of the mentors that Marcus Millichap told me when I was young, he's like, Dan, if you are a apartment broker and you don't own any apartments, you're like a ski instructor who's never skied. And I'm like, dude, I need it. I'm all in. So I need to own some doors.
Yes. Yeah.
So that was big for me. But the thing about buying these buildings that were in a great location where I didn't have a partner was I want to make sure I've got enough liquidity to where I'm not like in another pickle again to where I need to sell an asset, because you don't want to sell assets and that you cost seg because you're gonna have to pay recapture. So you got to be careful with that. So that's why I'm like, I own these free. I own these on my own. I have debt on them. I own these 100% on my own. I'm going to end up paying them off. I could 1031 exchange them one day, but I'm not going to, they're not overly leveraged. They're great real estate. I'm not worried about wiping out all the cost seg. Some people don't like it, but
I think for you as like the primary source of your income is through your brokerage, right?
Yeah.
And so I think for anyone listening to this right now, it's an important lesson. If you are a business owner or you are self-employed and you are making really good money, and like for you, you just need to park this money into these assets, and you're buying in good locations. You know the area. You have no reason to sell and increase the velocity of money. Now, on the flip side, if you're like a full-time real estate investor, and that was your primary business, then it's like, okay, then that would make sense.
I can optimize
to look at some of these deals and be like, okay, I kind of maxed out the value here. Let me sell and move that equity into a bigger opportunity with more value add potential, and I can keep increasing the velocity of money and keep growing my equity. But like, that's not your primary thing, right?
Tough.
You're just parking money.
It's tough because I'm kind of stuck in a good way. I'm good stuck in the brokerage because I'm making good money. So it's like I'm straddling like, okay, do I want to be a buyer or do I want to be a broker? And it's really hard to do both. So I'm just stuck in the broker side of it while still participating. But if you look at it, rough numbers, I bought 4 on that street. I think the cost seg was tax savings saved me enough money to buy the 4th building.
That's so huge. Yeah.
And all those properties have shot through the roof in value.
Question for you. How come like a lot of these like, even I'm sure you know a lot of old school investors, a lot of them never heard of the cost seg before and they've been investing in apartments for a while.
Yeah.
Why is that?
It's interesting because like one of my, really good clients has a number of buildings and I'm like, why don't you cost seg? He's like, I own so much, just a standardized depreciation structure wipes out
enough. He doesn't need
enough. Like I don't need it.
Yeah.
I don't have this huge income on, 1099. So he can wipe it all out. But I think some other people turned on to it that were older and got into it and started really scaling up. But yeah, a lot of people I don't think need it as much.
Yeah.
But you need to know about it.
Mm-hmm.
You need to
like
know
Carlton Dennis. I'm good friends with him. He was on the show recently. And he's actually up in Newport, but he's like, dude, he has all these freaking like high income earning business clients of his. And a lot of them are starting to get in the cost seg game. They're not real estate investors by any means, but he's like educating them. He's like, dude, you're making so much you're giving so much money to the Fed like you need to buy a freaking short-term rental or two and get a cost seg and start freaking, saving some tax money, then roll that into more real estate. And so I think the cat's starting to get out of the bag a little bit, but I'm always shocked by how few people really even know that this is an opportunity.
So this year we can get the bonus depreciation step down to 60%. So if you own
and that's not going back because it was going to go to 100. Potentially, it got voted down.
Yeah, I know. Hopefully, we'll see what happens. But on the tax wise, but yeah, you're right. So it's going to end up sunsetting. So 60% this year. So I think we got to look at buying good real estate. But I'm not cost segging buildings that are like higher risk and taking on a ton of, I want to make sure I make money in my practice. So anybody who's, and I go to my CPA, he's like, Dan, you're optimizing everything you possibly can, and that's the name of the game. Because then I realized I can be over here brokering and making money, but if I'm not paying attention to my bottom line, at first it's just like top line revenue. Then it's like, well, you have to start paying attention to your bottom line. And if you tweak your bottom line a little bit more and you optimize your after tax net, that's more than you significantly improving your brokerage business. So that's when you really have to have a wake up call.
Yeah, no, absolutely. And then in addition to that, it's like, okay, it's not just the tax savings from the cost seg, but you buying in good locations in 10, 15, 20 years, that compounded over, you mentioned you're buying a new building every year. I mean, that over 15, 20 years is, that's a nice seed money for your kids and your grandkids.
Yeah. And I did refinance and pull cash out and bought another building out of those 4 triplexes. And I added a little bit of cash, and I went to an owner, and it's great because I can get advice from all these, guys and gals that have done well and built huge portfolios. And I remember talking to buddy Paul, and I'm like, it was when rates are dropping, and rates were like, I had great rates. I had 3% interest only.
Damn.
10-year.
Damn.
And I'm like, I can refinance, but shouldn't I just pay these off? I think I should just pay, because I'm conservative, because remember I went through some heavy financial stuff back in the day. So that's adjusted my risk tolerance a little bit. But he goes, well, can you pay all these off and retire? And I go, well, no, I can't do that. He's like, well, you got to keep going. You got to keep going, dude. So I actually took a higher rate. I took the rates to 375 10 years IO. I got 7 and 10-year IO, but I ripped out, I want to say it was like 600,000. My payment jumped up a little bit, and I was able to pull all that money out. I bought another building, cost seg that.
Yeah. Huge.
So
that's the game.
You kind of get hooked on
real estate buys you more real estate.
Real estate buys you more real estate. And you kind of get hooked on it to where it's like, okay, now I only want IO debt. I don't want amortizing debt, because you kind of get used to the IO, and it is nice paying down a building. But I think until I can kind of get to a certain level, I want to continue to keep growing, and then not, just like having my kids inherit it all one day and they get the, I want to, improve my cash flow. So then I made it a goal. All right, what's my cash flow? And then I've been growing that, and I was able to 10x my cash flow over probably 5 years.
Dude, I love that.
So it's a game.
When will you buy a yacht in Newport Beach?
I don't know, man. I think going on yours. I got a little Duffy boat. So that's the opposite. I don't even know if that's considered a boat. That's like a golf cart on the water. But
yeah,
I got a Duffy.
Is your place on the water?
I'm not on the water. I'm in Dover Shores, but close to the water, very close to the boat.
And so where do you keep your boat?
There's this apartment building next to Bay Shores.
Okay.
It's called the Bay Shores Apartments, and keep it there.
Nice.
Yeah. But
how often are you on the Duffy?
Not as much anymore, because my kids are saying, Daddy, the boat's too small.
Oh, damn.
Need to go on your boat, dude. But in COVID, it was perfect, because we'd get out there. My wife was pregnant. She didn't want to be, around a bunch of people, but we wanted to see nature. It was awesome. But we'll get out. We'll take clients out. We'll get out there. I mean, this is like some of the best sunsets right now.
Yeah.
It's Duffy time. You
yeah.
know?
So last question for you, man. So with the rate environment, there's a lot of talk about it tapering down and stabilizing. What's your one piece of advice for maybe buyers out there in the marketplace in Orange County looking for multifamily right now? Would you say, hey, this is the time to go and attack, or would you say maybe hold off a little bit and let's see what happens after the election?
I'm always looking at, I think finding the opportunity makes the decision. You always got to be looking. But I think right now what a couple of clients have done, and this was just indirectly, it worked out in their favor. They negotiated contracts, put them under contract, and then they didn't lock their rate. They let it float, and the rate's been dropping down. They're like, hey, I'm really stoked. And that could happen again. That could happen right now, because a lot of people are like, I'm just going to wait and see what happens. I want to see what happens to rates. Then I'm going to kind of make a decision, or I'm going to wait till after November. But I mean, I think you might actually find a good deal, and you might get a little fortunate, but the deal's got to be solid, you know, but
And have a long time horizon.
it's got to have a long, because I think the flip games, not as many people are going to be doing it. This is turning more into traditional long-term, 7-10 year holds kind of thing. So, but I think if I was in a trade right now, I'd be trying to put a property under contract right now, because if there is a adjustment in rate, the seller, is going to be aware of that. So you might get lucky.
I love it. Dan, I appreciate you coming on, my man. I'm a big fan of everything you're doing. Respect the hustle, man. Humble beginnings, living in the car, and now you built this big thing, crushing it. We'll definitely have to connect, man. I'm up in OC every now and then, and if I'm ever in Newport, man, I'll hit you up, and would love to have you down here for a meetup one of these days.
I'll come down anytime. I appreciate you having me on.
Boris, where can the folks get in touch with you?
Multifamily SoCal, Instagram, YouTube, all the social media platforms, Multifamily SoCal.
And you're with CBRE, you said.
We're with CBRE. We've got an amazing team. I didn't even really go into that, but shout out to the team, because the team has made it happen.
Let's go. Let's go. Your
Yeah.
team have a website?
Yeah, multifamilysocal.com.
There it is, multifamilysocal.com. Go check him out. He's Dan Blackwell. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.